Hey guys, this is Toby Mathis, one of the founders at Anderson Business Advisors. And a question we get quite often is, what accounts should I put my money into? Sounds very generic, but let me give you kind of your options. So first off, in the world of banking, there's your typical checking account where you're not getting paid anything. There's a savings account where you might get, these days, less than 0.25% of interest on a yearly basis. And then we switch over and you have things like certificates of deposit, CDs, where they pay you a fixed interest rate, but you can't touch the money. And then we switch over to kind of the brokerage world where we have money market, where they have whatever the money market rate of return. Again, it's going to be better than a savings account, but it's still going to be fairly low. And then you have other types of investments you can put your money into, like brokerages, where you're putting it into an exchange traded fund. You buy your mutual funds, which I would never suggest because they have exchange traded funds, which are a lot less and more bang for your buck and more transparent. But there's lots of different kind of accounts. And so I'm just going to compare and contrast two of those. Number one, you have your traditional banking, and then you also have brokerage. And you're going to find that the line gets blurred between those quite often. And then I'm also going to talk about doing things individually versus doing things as a business. And there is going to be quite a bit of a difference between those two treatments from an asset protection standpoint, from a tax standpoint, and from a legacy standpoint. I'm just going to touch on all these things real briefly, and then I'll go over into some specific companies that I like to work with. So number one, a lot of us are really used to having a checking account. We have our ATM card. Sometimes we write checks. A lot of us don't write checks anymore. You're going to do electronically. You're going to write your electronic checks and things like that. And that's typical for an individual. And I wouldn't say don't do that. Also typical for an individual is if they have extra cash, they'll probably put it in a savings account. So they're earning something on it. Now keep in mind that inflation runs somewhere between 2.5% and 3% a year. So if your money is sitting in a savings account, every day it's sitting there, it's actually losing value. That money's becoming less and less valuable just because the cost of items are going up faster than that money is growing. So in 20 years, you'd be pretty disappointed if you kept your money in a checking account or a savings account. So as an individual, you may want to look at doing money markets or investing in the broader markets. And there are these things called ETFs. So first off, you have multiple stock exchanges. The big ones, kind of like the Dow and the NASDAQ and some of these, those are bigger exchanges. But there's about, I think it's somewhere around 5,000, if not more, actual exchanges. And there's tens of thousands of stocks that you could invest in. And I narrow it down and say, look, let's look at certain sectors like staples and utilities and things like that. And maybe we could just buy a bucket of stocks, different stocks in those. And that's an ETF where you're buying a broader market. Some people would buy the Qs. Some people would buy the XLY. All these things have different names where you're buying different sectors in the market. Or you could just buy specific stocks that you like, companies that have a long history of success. And I use something called Dividend Aristocrats and Dividend Kings to make a preliminary decision because it narrows down the entire marketplace. Let's say there's over 3,000 stocks on the stock exchange, the New York Stock Exchange or the Dow, and you're looking at it and you narrow it down to something around 50 companies that you're going to focus on. Those 50 companies have been paying increasing dividend amounts, which is the amount of profit it's paying out to the shareholders that own it for the better part of 25 or 50 years. Kings are 50 years plus, aristocrats are 25 years plus. So all kings are aristocrats, but not all aristocrats or not all aristocrats are kings. And I think there's about 25 companies that qualify as a king right now. Johnson & Johnson, Procter & Gamble, things like that. And then you have IBM just hit it. And then you have your aristocrats, which are the Walmarts, things like that. You actually, there's a whole list of them. We do something called Infinity Investing. If you feel like it, we do a free class on that, and we have all the companies in there too. So by all means, feel free to check that out. But that's where you're actually putting your money into something that's going to pay you to own it. And the reason that I like those kings and aristocrats is they average the dividends pretty much keep up with inflation. They're between 2% and 3% on average, and there's some that are higher and some that are lower. So, for example, you may be looking at a company, Altria, I was just looking at, and it was about a 8% dividend rate. It's actually paying out a pretty hefty dividend, so it's beating out inflation. So if all you did was to buy some of these companies that have dividend rates over 3%, you'd be keeping up with inflation. It's just you're in the stock market. And if you wanted to liquidate, there's two things that you got to be concerned about: is liquidating when you're at a loss position, which shouldn't happen, but let's just say it did, the market crashed. Then you lose money when you liquidate it, or you're liquidating as it's gone up in value, and you're going to end up paying a little bit of capital gains on it. When you receive the dividends, it's treated as long-term capital gains. So it is income, so it does pay a little bit of tax, but it's greatly reduced. Long-term capital gains are taxed at 0%, 15%, or 20%, depending on how much money you make, your adjusted gross income. So if you're somebody who's modest, it's probably going to be 0%. You're not going to pay any tax on that, which is nice. But that just continues to grow in your account. When you sell a stock, it usually takes 3 days to get the cash. It's called clearing, and then the cash is available in your account, and then you can spend it out of your account just like you would a checking account. So it's sometimes lost on me when I see people with large amounts of money sitting in a checking account. And I say, well, I mean, worst case scenario, you should move that into something that's earning interest. And so you'd go from, hey, at least have a savings account, to it's probably better to have a money market account, and you could get these things for free. Robinhood is exceedingly simple to open up. It's app-based, but you could do it online through a regular browser as well. But it's easy to utilize. Schwab and TD Ameritrade, which Schwab just bought, TD Ameritrade, they're exceedingly easy to use. You can trade for free. You can get check writing. You can get ATMs. You can go E-Trade. You could go, if you're an advanced trader, then on the TD Ameritrade platform, there's Thinkorswim. Like there's basically, at this point, there's been a race to the bottom as far as price. And if you're paying money to trade equities, you're probably in the wrong platform. You should go to something where it's free. And Schwab, TD Ameritrade are easy. I have accounts with, I've had it with E-Trade, but I have Schwab, TD Ameritrade, Robinhood. I still have a Robinhood account. I have a Fidelity account. They're all pretty much equivalent as far as ease of use, but then your money is sitting there and it's very easy to access. Now that takes us to the last leg of this, which is, how should I own it? If I own it in my individual name, it's mine. So if I get into a car accident, or if one of my kids gets into a car accident, that money is available to anybody who's coming after me. If I have a business and I have the money in there, anything I do in my business, they could get to that money. So I tend to put these types of funds in their own little, something called an LLC. It's like a virtual safe where you put the money into something where they can't touch it. And when I say they, it's lawyers, snoops, anybody trying to get things. You fill in the blank, somebody trying to take something from you. They can't see it and they can't take it even if they could. And there's jurisdictions where it's completely anonymous ownership. And I'm not talking about going to, the Cook Islands or any of these crazy things. Domestically, you can just go to a state that doesn't report the information. There's a couple that are easy. Wyoming and Nevada are probably the best. Wyoming being my personal favorite right now. Inexpensive, and you're able to put things inside of a box. Now, I wouldn't do that if I had $25,000. I would do that if I had over $100,000, and then it's kind of a personal choice in between there as to what your risk exposure is and whether you have any concerns. But it's not a bad idea, So I may have a checking account personally that I keep X number of dollars in. I may have a savings account personally that I keep Y. And then when I'm accumulating cash, I push it off into an LLC, and that's Z. And that's where I'm keeping my cash where nobody can touch. And the easiest way to think of this is if somebody was to go to your house, if I had cash just sitting out on the, right in the front window where they could look in and see a big pile of cash, it's probably not the smartest thing. That's going to tempt somebody to borrow your cash for you. If the door was open and the cash was sitting right there inside the open door, you're really begging people. And that's what you're doing when it's in your personal name and everything's just right there. If you're running a business as a sole proprietor, that's insanity, because they could just follow you around the rest of your life and they take your cash every time you try to get it. They're going to garnish accounts. They're going to garnish you. So one of the easiest things to do is to close the door, close the blind so they can't see it. that's number one, is making sure it's not just sitting there in your name, maybe putting it into a different account. That's great. Moving it to another entity. That's great. But the best thing is to put it into a safe. And most of us would have a safe in our house where we might keep a small amount of cash. But that safe is still in your house. And if they break into your house, they could potentially take your safe. So we tend to look at these things and say, hey, rather than just like a safety deposit box and having actual cash, because it's losing value sitting in that safety deposit box, we use what's basically a virtual safe, a virtual vault, and we put the money into an area that nobody can touch. And I can take the money in and out all I want. It doesn't have to file a tax return if I don't want to. There's ways to set these things up where they're completely transparent, but it takes the money out of your name. Now, lastly, there's tax advantages, and I'm just going to touch on two. Number one, if you're going to put money aside in savings, don't do it in a checking account. Don't do it in a savings account. Open up a brokerage account, but you might want to open up a Roth IRA brokerage account. If it's going to be $5,000 a year, $6,000 a year, that's a tremendous tool. If you need the cash, you can take it out. But if you don't, it grows tax-free. You'll never pay tax on that money when you take it out. You just let it sit in there, and then when it comes retirement time, you never have to pay any tax on it. Number two is if you put it into an account like an LLC, there's a possibility of, if depending on how much money is being made, as using a strategy of having a management entity, changing that LLC into a partnership. And now we have access to some advanced tax strategies where we can save and we can generate tax deductions on average of about $20,000 to $25,000 a year. So if you are making off of your trading account somewhere in the neighborhood of 10 to 20 to on up, this is something you definitely want to consider, because we can take money that might be taxable to you and shelter that money for the future. There's ways to get money out in a tax advantaged manner if you set this up as a business, and that's a whole other topic for another day. But you get the idea of how we take something and how we hold different investment accounts.